Hello guys and welcome to today's YouTube video. In this video I will talk about what dollar averaging actually is and how you can use this. Before I'm going to explain what it actually is, I will give you a brief example of when it is useful. So let's assume that we are in the end of 2021 and that you have never invested before. Let's say that you do have $100,000 in your bank account and you want to be an investor. So before 2022 starts, you wanted to invest this money in the stock market. Now, let's say that as many other new investors, we want to invest in a very interesting company. This could be companies like Tesla, this could be a company like Netflix, this could be a company like Amazon, Apple, whatever it is. And you basically invest these $100,000 into the same company. Now, let's see what the graph has to say for these companies for 2022. So, basically, based on the graph, you are able to see that a very large portion of your initial investment is actually lost. By having used a dollar averaging strategy, you could potentially have avoided this. Using a dollar averaging strategy doesn't mean that you can't lose money, but it does mean that you wouldn't have lost 25% of your initial investment of $100,000. The reason is because you don't invest all of the initial amount at once when you're using a dollar averaging strategy, but you are spreading your investment out. And the reason why you want to do this overall is to make sure you don't buy just before a major dip is happening. So unless you are perfectly able to predict the market movements, which I don't really think you are, because if you were able to do that, then you would most likely be a multi-billionaire or something like that. But so let's assume that you like the majority of other people are not able to predict the outcome of the market, then this dollar averaging strategy might be something for you in order to reduce your overall risk and make sure that you don't buy when the market is at its all-time highest and just before it sort of like decreases again. You always want to make sure that you reduce the overall risk you have when you do your investments. And here is where the dollar averaging strategy does come into play, and it is exactly what I'm using it for when I'm buying stocks. So let's teach you guys about what dollar averaging strategy actually is. So let's stick with the same example as we had before, where we had this new investor who actually had $100,000 in his bank account. This new investor, he wanted to invest in the stock market. In the example before, he used all of the money at once and just invested all of the money into a single company. That is when you're not using dollar averaging strategy. If you were using dollar averaging strategy, then you would have taken these $100,000 and you would have divided this into some smaller portions. It could, for example, be that you wanted to divide this by 5. That would essentially mean that you now have 5 different portions with a total amount of 20,000 in each portion. Now, let's say that for January, you want to invest the first portion of this money into this company. The second month you're going to invest the second portion of the money, and the third month you're going to invest the third portion of the money, and so on. By using this strategy, you will make sure that you never ever buy for the total amount of money you have when the market is at its highest points. This means that you buy in the same company 5 times, which does overall decrease the risk of buying when the market is super overvalued, and thereby reduces your overall risk. So that is essentially what dollar cost averaging strategy actually is about. It is about not investing all of the money at once, because it does come with a very high risk unless you're able to predict the future outcome of the market. Now, there are potential downsides of this strategy as well, as there is with anything in life. And basically the biggest sort of like critique of this strategy is that, well, what if you're buying when the market is low and you don't go all in? Well, basically it's the same argument as buying when it's high. If you are 100% sure that this stock is at its all-time lowest and that it's only gonna get higher from now on, well, then you can go all in. But if you're like me, are not really able to predict that, then using this strategy is a very safe way to do it. This is a strategy that I have used for several years now, and I will continue using this strategy as it does help me increase my overall return on my stocks. This is also a strategy, one of the few strategies that, according to many studies out there, has actually proven to work over time. It is not something that has just worked for a certain period of years, but it has worked through history in very many different circumstances. and it is one of the most well-known and most used strategies when it comes to investing in stocks. So I do hope that you liked this video, and if you did, please press the like button and subscribe to my channel if you want to see more videos like this one. Thank you for watching.